right now. Or are we late? We're late, aren't we?
Well, but it doesn't matter because we hopped on and in 30 seconds, we're going live. Let's go. So it's always fun when we do lives because for people that maybe don't know, one of the things I like to chat about every once in a while is the Kolbe Index, Kolbe, Kolbe. If you're not familiar, you can go to KOLB, Kolbe, I believe it's Kolbe.com, and you're looking for something called the Kolbe A Index. And I don't know, there's like 36 questions or something you answer. And people like to refer to it as like a personality assessment. Man, I got to really work on. I'm using a lot of air quotes lately. I can't help myself. Something about like the camera, and I'm like, what does it look like when I frame my head like this? Is this a bunny? But the do you remember on SNL the I think it was Chris Farley? He was the guy. His name was Bennett Brower. He would do on the weekend updates, and he'd be like, "So what if I don't use deodorant and brush my teeth regularly?" Anyway, sometimes I do that in client meetings. But talking about the Kolbe Index just really quick, and then we'll talk about IBC stuff. But both Vern and I are high quick start. So there's kind of 4 measurements of, how you do things. And Kolbe isn't really personality related. It's more about instinct. It's your instinctual, natural way of doing things, of attacking a project or, completing a task, etc. And so Vern and I are very high on the quick start index. So whenever we hop onto a call, a lot of times, what are we going to talk about? I don't know. Hit go button. Let's go. Let's get started. And then it just kind of develops from there. So it ends up being fun and engaging. And it's a varied amount of activity and discussions that can happen, which usually there's some ideas that get generated in a conversation like that. Would you say?
Yeah, I wish I could say, Rich, that I don't occasionally over leverage my quick start, but I certainly do. But I'll tell you, thanks for sharing that with me back in the day when I first discovered it, because I mean, procrastinators are killer for everybody, but particularly for you and I, these quick starts out there. If I don't have a plan in place to take the action, or if I don't take the action immediately, consider it's not going to get done. Procrastination is a killer for me.
Which is funny because we just finished an amazing podcast recording with one of our teammates, Niffer, which was a ton of fun. So can't wait for that episode to come out. But one of the things you mentioned before we kind of started the call, we were doing like a bit of a positive power up, which is something that we do frequently at the Ascendant organization. And you were indicating that, hey, you kind of burned in the midnight oil last night, and you basically smashed out a whole bunch of, a backlog of work, right? Because we have meetings. A lot of times we're doing meetings that's back to back meetings. And you do that for like 2-3 days straight. It can be a little taxing. You're on Zoom, you're sitting in your chair, you're at a stand-up desk, and it's just nonstop meeting to meeting. And then there's a lot of tasks that get created as we're helping people implement this process in their life. Yeah. And, but you need to have time carved in your calendar to start really working on that stuff. You got to do a needs analysis. You got to prepare some illustrations. You got to think on what you learned in that client meeting, and okay, how can we structure and plan? Like there's some really, really intense focused effort that has to go in, and it's a lot of thinking work, right? But it takes time, and we got to put that time in, because how we're helping people is what matters. And is that you using reminders with that thing? What are you doing with that?
No, what I do is when I finished my last client meeting last night, I had dinner with my family, and I said, hey, what do you guys want to do? Dad's going to put in some midnight oil tonight, or I'm working late Friday, or possibly Saturday morning. What do you think's best? They're like, Dad, go crush it. I'm like, cool. So I put on like shorts and a t-shirt, got comfortable, grabbed my, Spotify playlist. I turned on my Bluetooth, and I just like blasted the music, and it's like I'm in my zone, getting everything taken care of. Right. So that's why I showed my speaker. That helps, pump the energy up.
Yeah, I love it. And you know what? And that's the thing. You've got like a little mental trick to help you get through that. But it's enjoyable, but it becomes more enjoyable to do it that way. And you don't have to kind of be, front stage necessarily. You're not on with people at that moment, but you're working on really critically important things. And even I find, yesterday I had a pretty busy meeting, and, because of my quick start and other Kolbe related activity, people who have meetings with Richard, they start to learn real fast. Richard's not so good at watching the clock. It's a real downfall of mine. So I'll even begin a lot of my meetings like, just so you know, heads up, I tend to not pay attention to the clock at all. And some of my meetings tend to go long because I just get so ingrained and engrossed in what we're doing, our conversation and like the thinking and the planning and the discovery and the questions that get asked. And I just kind of lose myself in that activity, because it's not only is it highly enjoyable, but we're accomplishing something. We're working on something really important. And then all of a sudden, like, I get a reminder pop up and they're like, oh, your next meeting starts in 5 minutes. Like, oh, right.
I gotta go.
Let's wrap this up very quickly. And so, that's part of my nature, it has been beneficial for me, but it also has counterbalance of where it's not as well. So, I recognize that it's something, we're all a work in progress, right? We're all trying to get better in areas of our life, and that we want to improve. And that's an area that I'm always seeking improvement. Sometimes I find like little Jedi mind tricks that work for a little period of time. Like, these are not the droids you're looking for, but they don't always work, or they work for a limited amount of time. And then I have to, like, I need some other Jedi to come and, like, get me back on track. So, but interestingly enough, on that very same topic, I was talking with a good colleague of mine the other day, Jimmy, and he's, really good guy, he's an amazing coach. And he's talking about, the power of habits, and a couple of books that he's read, one of them, Atomic Habits. And it's been on my list for a long time. I haven't got to it, but actually smashed through most of it on audiobook over the last 3 days. So back on Audible. It's been a hiatus since I've been doing that, but I'm back on it. And it's good to hear, like, these little small intricate things that we do that create habits that have a really powerful effect in my life. And it's the small thing that leads to the next thing and the next thing and the next thing. And I was thinking, as I'm listening to the book, and I'm trying to implement some new, morning routine habits. Routines are very difficult for me in that let me rephrase that. I'm going to change my language. I have not prioritized routines in my life because they're kind of the antithesis of what my Kolbe says I should do. It says I should not be routine oriented in any way. And that usually works out all right for me. But there's certain areas where I really want to have a little bit more routine. So I'm focusing on some new morning habits for myself. And I'm really happy about how it's going. But as I'm doing that work and I'm thinking about this book, I'm thinking about the habits that are important for IBC, the habits that we're teaching and helping our clients learn and understand, and having, discussions with them on a regular basis, or having them embrace the content that we're producing so they can really embrace those habits. They're going to watch a video from, Sarblo or Roman or yourself or Jinjin or some, Jason or some other member of the team. And there's like some comment that just sparks them, like, oh, that's the little nudge that I needed to improve that one thing a little bit more efficiently.
It happens. Rich, I'm so pumped. I'm so grateful for the team. I'm so grateful that I'm not the one who has to do all that on my own, because just yesterday I met with my client and they were referring to maybe a couple of videos that I was a part of or that I recorded. But just like what you said, they actually know our teammates. They're dropping other people's names and say, oh yeah, Roman did this video and he said this, and man, that really got me thinking. That's why I booked this meeting today. Like, how good is that, right? Like that is so good. And you're right about the habits. I'm with you with that. I struggle. Maybe you can coach me on the language here. I find it sometimes challenging to really create those routines and habits. I've often said this to you, where I'm really good at following a process. I'm not really great at creating the process. So I think, is that the follow through? Is that on the Kolbe report? Is that the follow through? I'm not sure, but I'm good at following the process. But if you ask me to create the spreadsheet or do this or do that, that's another reason why I'm grateful for the team. In fact, I showed on a video today. I just recorded with Roman earlier, so make sure you go to Banker's Vault. Eventually, this one will be getting processed and posted. I can't remember. I don't know when it's going to get posted, but we recorded the top 5 money leaks for Canadian families. And so we talked about the things that can have you leak money and that you don't even maybe notice it. But more importantly, what are some systems and processes that you can put in, of course, tied in with the process of becoming your own banker, but how can you actually tighten up those money leaks and make sure that money is being accounted for and flowing back to your family system? But it's one of those things where I have my own policy loan tracker. I update it on a monthly basis, and I'm so committed to it. It matters to me. And when things matter, you prioritize the time, just like what you're doing with the Atomic Habits. And you recognize that, hey, there's probably some benefit for me to create some kind of a morning routine, right? So same with, managing your system or whatever, right?
Well, and it's funny that you mentioned that because in our client portal, for anyone that's a client of Ascend Financial, we have a client membership portal. Many people will be familiar with it, and there's a ton of, not only is there a boatload of content in there, there's also a ton of like kind of templates and resources. And so there's links to access a loan amortization that we recommend you use to build an amortization or take a policy loan. How do you want to set the repayment terms? You control all these things, but the act of opening it, of printing it, of making that happen,
Totally.
doing that step is telling your brain this is important, and here's a commitment that I'm making. We have a loan commitment template that we've built where you can write down, hey, Richard took a policy loan from this policy and this policy, and this one was $3,000, this one was $10,000, and so it's $13,000. I'm applying this to, and there's like check boxes. So what are you putting it towards? It's like repayment of debt. I'm recapturing this. I'm buying a car. I'm making an investment. I'm buying Bitcoin, like whatever it is that you're doing. And then there's a big other box, and you just fill in whatever it is, so get specific with that. And then how I intend to repay this back is by doing blank. And there's a couple check boxes. And so then there's like a page 2, which is just like, it's like bullet points of things to remind yourself and be aware of. Don't steal it. There's a picture of a can of peas right on it. And you can sign and date it. And so we've been trained over our life that when you sign your name to something, that is usually important. You're making a commitment. You're signing a contract, usually, mortgage contract, real estate purchase contract. Like these are things that are really important decisions where you sign your name. And so the act of doing that is just one little kind of habit. And when you're talking about being your own banker, those little things matter, and they compound and they build up. And then you start to see, okay, maybe you have kids and they're seeing you to take a policy loan. You want to start talking about the family bank. Well, now you go to the file folder and you pull it out, and like, boom, here's all these loan requests stapled together with a loan commitment and an amortization. These are all policy loans for the family bank. Here's, we bought the hot tub with this. We bought the RV with this. We went on our family vacation with this. And now you have like all this data that you can use to have really cool and powerful conversations that support the financial growth of your whole family.
Yeah. And you can actually, to that point, I'm actually using, I don't want to name drop here, but a client of ours, I think it's specifically Sarvalo's client, but you know what I'm referring to. So from that last client coaching session, Sean, that last client coaching session on May 15th, we're building a community here. People, sometimes they start implementing this process or they hear about it and they go, hey, Richard, how come I've never heard of this before? And they assume that no one's doing this. And this is like out of nowhere. They're the first person who's going to get a policy and start accessing loans and banking this way. But we have literally thousands of clients across the country amongst our team who are practicing and implementing the process, not just the guys over here that tell you that, the guys and gals that tell you that it's a good idea. And this is what I've been able to do. My clients are achieving objectives every day. And so we get together on these client coaching sessions, and, the team is there to coach and share, advanced case studies or different ideas and different ways that you can implement the process and expand your system and so on. But now we're starting to get clients who are totally embracing the concept. And if they weren't already successful in the lane that they are in right now in life, they'd probably be here coaching people to implement it. And we've had clients come on. Sean did a great job, like a 25-minute video where he showed how his own policy loan tracker that he created, and there was a couple hundred people or 100 people on the call, and everybody was like blown away by the way that he manages the system and it makes his loan repayments and does it on a very scheduled, diligent way, including me. So again, being good at following a system, not so great at necessarily creating them. Guess who downloaded that spreadsheet and is now using that policy loan tracker as an excellent tool to make sure that I'm accountable to those money leaks, those expenses that can come up, the AC unit, the Calgary Stampede, the Blake Shelton concert. Those are all paid for by policy loans. And it's really easy to trick yourself to think just because I put lump sums of cash in my policies here and there, that's really me being, it's kind of like escapism. It's like me, using my quick start, whatever. It's easy to slam cash into a policy, but am I actually being diligent as a banker? I issued my family a loan to go do that thing. So did I create a loan repayment schedule to be accountable to make sure that I'm not stealing the peas? I'm putting back more than what I use. So I'm using a specific policy that I pulled the maximum loan out to recapture some debt. And now I've got my policy loan tracker, and I'm taking those specific payments. I put other cash in other places in my system, but that specific payment right now, it's up to about $4,000 a month. for my loan repayment schedule that I have, I'm putting it specifically in a segmented policy that had $0 to borrow out of it. But now I can actually, I like watching it, but now I get to walk my clients through my own tracker, and I can show them, hey, I took the policy loan on this date. Can you see that there was nothing there to borrow as of that day? And then now I've put back, $4,200. Well, how much can I borrow? Well, they're like, oh, you can borrow like $5,000. Do you see why you want to become your own banker? It's because I'm putting it back into a system I own and I control, and that cash is growing every single day. So I've been pretty excited about that process that I just started to implement here the last couple of months.
Oh, that's fantastic. And that was an amazing presentation. And again, it's available in our client portal for clients of the firm, which is fantastic. And there's many other ones, and there's great conversations about family banking. We've had certain videos that we've been able to play and then talk through and discuss. And I think a lot of the real value comes from those open discussions that we have. And we try, I mean, it's all technology. I mean, we're not like technology wizards or whatever. So you try to do a breakout room in Zoom. Sometimes it works, sometimes it doesn't. But we try to get some engagement and community building opportunities in those sessions as well. And I'm excited because I think our next one's scheduled around the end of September, if I remember correctly. And and then we're also planning a big event sometime in October in Edmonton. I don't remember the date offhand, but I believe we're going to be doing a good event for our clients, and I think also for the general public, which will be a lot of fun. It'll be good to be together with our team because we all work remotely and virtually, and we're scattered, across a lot of the country. And it's nice. A lot of us haven't been together in the same room in quite a long time. Part of that's because of geographic distance, and then also just because of the whole COVID business. But it's going to be a lot of fun to be together as a family, and as a family, the team oriented aspect, but also as the greater IBC kind of family comes together in an all in one building, which is kind of nice to see. So I always love that. That's an area where I get really inspired and enjoy. And hearing your story, how you're implementing Sean's tool that he shared with everybody, and my perspective, again, this kind of goes back to the Colby we were talking about earlier. Is I'm a simplifier, and that's probably too much energy and effort that you're putting in that I would want to do. So I try to keep it even simpler than that. I don't track anywhere near that well. And because of it, I'm not tracking as well. I may not be seeing the same level of gratification or success to the point that you are, but I'm also like, you know what? How much energy do I got to put in to do that tracking? I want to control my energy inputs a little bit. And so I do a lot less tracking in relation to how you're doing it. But I think what you're doing is fantastic. And one day maybe I'll get there, or maybe I'll just like convince someone else in my family to do it so that I don't have to. That's another
who not how, right?
Who not how, yeah.
But I'll add to that though, Rich, because like I said, you and I are very similar in that way. All I'm really doing, all I did was originally I just said, okay, I'm just going to start. I'm just going to start with one loan. I know that I bought this microphone, that camera, and my tripod. When I downloaded the spreadsheet, so thank you, Sean, he did make it available again to our teammates, but also it's available to our clients. They can go on there and they can download the spreadsheet. Super robust and very intuitive. But I downloaded it and I started playing around with it, and I just put in one loan. I just said, I'm just going to put in this one loan. And then I put it in there, and then I was like, oh, that was pretty easy. And then I just now I have probably 20 loans in there. They're all just there. So now I just got to spend a couple of minutes each month when I go to make the payment to look at what I have to send in. And then I just have to update, okay, made a payment type of thing. I say payment number 2, my tracker will go from, let's say it's 12 payments. It'll go from 11 payments down to 10. It'll tell me exactly the balance of the loan that's left there. And I'm totally with you. But yeah, it's just something that I'm slowly kind of integrating. We were talking about atomic habits earlier, and yeah, it is so far. Like it's one of those things. You're probably like this with me too. Like it might take me a little while to get started sometimes, but when I start seeing or doing something, and then I can start seeing the benefit, I kind of get hooked. I kind of get it. You kind of get a little addicted to it, right? So now I'm kind of like, I like kind of popping open my policy loan tracker and adding things to it and making sure that I'm fulfilling on my commitment that I make. Because now that I'm doing the tracker, my brain won't let me not do it now.
Right. Yeah, that's right. It's atomic habits. That's what it's all about. And then like, that's one of the things that the book talks about is, the thing that it's easier, something that you really don't like that makes a habit makes you form a habit because you don't want to have this bad result continue to happen, or it's something that you really like. And so what makes it easier to enforce and do those habits is that there's a reward on the other side. And this reward is a very powerful reward because you log in and you take a look at your policy portfolio and your loan portfolio, like, oh, look how much loans went down and access went up. And, and then you're looking at, okay, upcoming in the next 90 days, what are some of the, big picture target items I have where I'm going to need access to capital for. So part of that diligent items, like at the end of the day, we all want to have more success in our financial life. We are all different people. So one of the things that we do teach people is that, look, here's our method. Here's our way of doing it. But because your natural way of doing things might be different than somebody else's, some people are more inclined to be a little bit more detailed. They're going to be, excited about messing around with a spreadsheet. Whereas other people, if they're not doing it, in physical paper or whatever, then they can't see it, then they're not going to see the same success. So we try to help coach to what works for you. We're going to give you some tools and some ideas, and then implementing and recognizing what Nelson taught us. If you get and focus on the primary conceptual level of what's happening, don't take a policy loan unless you have a purpose for the loan and a intention on how you're going to pay it back. When Nelson says don't steal the peas, what he means is if you take a loan, put the money back in, put back more than you took out. Okay. Yeah. And if you put back more than you took out, you're paying yourself a quote unquote a spread of interest. Great. That fundamentally means there will be more money available for you to work with in your overall financial resources, because the money that you intentionally paid yourself didn't disappear to some other frivolous crap running through your life. It didn't go to, 45 doubles last month at Tim Hortons and 14 donuts or whatever that you went and got. It went to some strategic area of your life. Well, I mean, it's Friday. I mean, it could be a good day for a donut. But, that little premise is a very simple, like the concept of paying yourself first has been around for a very long time. Yes. A lot of people talk about you got to pay yourself first, but people don't really know how to do that. It seems so simple, but yet it's so ambiguous that they're like, they get stuck on what the how is. Well, the how is really simple. You go get a well-designed, high cash value participating insurance policy that builds like a cash machine over your entire lifespan. I don't care who the body is. That's an amazing way to pay yourself because you have a forced payment in your life. There's a premium that must be paid. And then there's a big flexible portion, which is optional, but highly important. It's a turbo booster for the insurance. And you get to build and design that with your coach. Then as you get that machine working, now you have capitalization taking place. Now there's things you need to do in life. Boom, you have access to a resource of capital that you own and control and can use. And you have habits and skills, coaching, mentorship, tools and resources to begin implementing that so that you're improving little bits and pieces along the way. There's a saying about the death of 1,000 paper cuts. Well, those money leaks that you and Roman talked about, that's how we have money disappear out of a life, and it has a compound effect over a lifespan. So if we can close those leaks and we can harness the potential of that money by being focused with our energy and focused with our habits, more financial prosperity comes to you. And that's why we teach people this isn't about an insurance contract. This is about how you think. Nelson would say it's all about how you think. It's all about how you think. It's all about how you think. And that's how he would say it. He would begin every presentation he would do, every seminar with that statement.
Yeah, that's so good, Rich. You nailed it. A couple things. The reason why I was pointing to those specific words on there, your own, the key words are your own. So just because maybe Vern or whoever uses this tracker and Richard does it his way, well, that's because that's Richard's bank and that's his family and that's how he runs his bank and that's what works with him, right? So every client's banking system and how they operate it is going to look as different as their thumbprint. That's the first point that I wanted to make. And the other point was when you were talking about paying yourself first. Some people say that. Am I really paying myself first if I put my payment quote into some savings account at someone else's bank? Is really kind of paying them first. So what I want to do is I want to build a system with a contract that has guarantees at a company that I co-own, where I get to participate in the profit. And every time I drop that premium in there or a loan repayment, I'm truly paying myself first, because I'm the one who gets use and control over that money, and it's actually being put to work for me and my family rather than somebody else's. So yeah, it's you hit some good points there.
There's a spot in the book, and I'm just trying to remember where it is. I believe it was somewhere near like page 37 or 36 or something, and it talks about, Nelson talks about the First National Bank of Midland, Texas. I can't remember the exact page right now; it's escaping me. But the
Yes.
whole concept that he walks through is basically the the whole purpose of putting in the book is to help people understand, how do you kill the best business in the world, a bank. The First National Bank of Midland, Texas was the most like profitable bank per capita population base in the United States, for quite a long period of time, a lot of oil money and stuff like that. And then the shareholders of the bank, they all got onto the greed money cycle of everyone's making, hundreds of millions of dollars or whatever in the oil business. And there's all these oil projects where they're trying to find oil and discover oil. And so they're now getting involved. Well, what do? They're taking loans out of the bank that they own. They're the main like shareholders, but they weren't paying the loans back. They were non-performing loans.
Right.
And because they weren't paying the loan back, there was no capitalization left in the bank. They'd stripped all the money out and they weren't making repayments. And then oil went down and everything kind of, went bad. And so the actions and the habits of the shareholders running that bank caused a major problem that caused that bank to fail. And that, thousands of people were out a lot of money. The depositors, everybody had a problem because of the poor habits and poor decision making, and the lack of knowledge and understanding of banking in general for the people that own that bank. And so that whole story is there to teach us an important lesson. Again, we sound like we're kind of on a wheel here of just a repeat, but it's all about how you think. The policy owner's behavior is far more important than the behavior of the insurance company in this process.
Yeah, and I know we're running out of time here, Rich, but you're exactly right. Just one quick point about the unseen, about those money leaks. If I spend the money, and you talked about the compounding factor of that basically working against you, because you spent the money, it's gone, it's no longer working for you. You can't really see that. But to contrast it, what's really cool is going back to my loan tracker. Even if you make lump sums or do whatever it is that you're doing, the cool thing is you actually kind of can see the benefit of when you're paying it back to your system. You're putting back more than what you use, plus your cash flow is rising every day. You can actually see. I equate that as, oh, that's me actually recapturing that lost opportunity cost on those dollars. When I put $4,200 in and there's $4,500 there for me to borrow, where'd that $300 come from? That's just from the way that I think, the way that I structured myself, the way that the policy, the tool that I choose to warehouse my capital in, the way that it works, it allows me to recapture that interest and have more capital available to do more things with for my family. So I just wanted to kind of share that, because I'm just super. Now you got me all jacked up, man. I'm going to go do some jumping jacks or something before my next meeting. Otherwise, I'll be talking 1,000 miles a minute.
Well, I mean, maybe for me, I probably should be talking 1,000 miles a minute. It would get me through my meetings a lot faster, because my meetings always, we were talking earlier how my meetings always go over time. But, we actually have a great question that's come in from Farida, and this is about stock versus mutual company. So I'm just going to tie on that really good because,
Sure.
she's posted about this question. And so, in Canada, so in Nelson's book, he's talking about working with a mutual insurance company. That is always our goal and our focus. And the difference between the US and Canada, there are some differences between our countries. They're not dramatic. On the big scheme of things, they're really minor. But from a how the stock companies versus mutual companies work is a bit one of those areas. In Canada, we're very well regulated here, and so because of that, stock companies, meaning an insurance company that is stock owned, means you can go and purchase them on a stock exchange. So most of the major large insurance companies in Canada are like that. In fact, during the late 90s and the early 2000s, roughly between like 1999 and 2004, most of the big companies demutualized, meaning they had a vote with the participating owners. I believe they needed to have a 75% approval vote, 70 or 75% approval. And if you were an owner, you had a participating policy at that time as an owner, you had to sign off basically and agree to vote to demutualize the company. When that happened, it was kind of like the equivalent of the insurance company doing an IPO. All right. They're going public. And so they're going to issue stock. And because you were an owner in the company, the only way you could be an owner prior to that was to have participating whole life. So if you already had it, you still had the policy, you still had all your benefits, but now you were issued stock in the new company relevant to the size of your policy. How big of an owner were you? Did you have $1 million a year premium, or did you have $100 a month premium? Okay. And for many people during that period, that was like the closest to like a lottery ticket win. Basically, it was a hugely financial beneficial for a lot of people. Now those companies have done all that. That was, 20, 30 years ago or whatever, when that happened. And now, in Canada, there's a very few amount of mutual companies that are left. And so we do a lot of our business with one of the largest remaining companies that does that. They're fantastic. I personally own a lot of policies with them. My family, Vern, you do. Most of my policies are with that company. Most of my clients have policies with that company. However, we also do business with other companies, and there's many reasons for that. So the stock companies in Canada, I mean, we only have so many choices available. There's only so many companies that have a good quality product that allows for efficient deposits and cash accumulation, as well as a reasonably efficient loans process. So there's check boxes that we're trying to hit so that we can get the right tool in the hands of the client so they can practice the concept. All right. And so we often have to do business with some of those stock companies. They have great par products, and their pool is separated. So just like imagine you have like this giant circle, and this is the company. And then inside of that giant circle is another giant circle, and that's the par account. It's managed and separated, and it's managed in a very specific way, and it's governed on how it's managed. And that par account it's kind of almost like a business within a business. And so it manages and operates the same way. It pays, dividends when it's profitable. It does all the same things that the contract does now. A small, tiny little sliver of that, when they pay a dividend every year, a tiny sliver can be issued out to the stockholders. It's a pretty small amount. And as that pool grows, the amount of the sliver actually goes down. It's kind of interesting. So it's very well regulated in Canada. Whereas in a mutual company, it's all one big pool, and everything that the company does is kind of in that pool. So they sell other products. They'll sell term insurance, group benefits, segregated funds, and, a variety, critical illness, all these other types of products. All those products are all kind of mashed together in the financials at the end of the year. How did we do as a business? We took money in, we paid money out. We had expenses, we had some claims, and then we took more money in. So at the end of the year, how did we do as a business? And then this determines what amount can now be issued out for dividends. So you participate, what we would refer to, on all lines of business when you're in a mutual company, which is really good. And then additionally, with the stock company, you only participate now on the par pool. You don't participate on the other products and services anymore.
Right.
And the other thing, and so not to call it problematic, but there's some problematic aspect, is in a stock company, they have stockholders and they have par holders. So they kind of have two masters, right? They got to appease both of these people. And I'm not a stock ninja or whatever, but I understand that every quarter, when you are listed on a stock exchange, you have to report some numbers to those people. And, the shareholders, they're hoping for some decent numbers every quarter, and they get really upset when they're not. So there's a lot of activity on the stock company side to try to make sure that they're pumping out good numbers when they get their quarterly report, right? And so where their focus is versus in the mutual company, 100% of all their focus is on their par owners because they have no other masters. Yeah. So there's a mindset differential that's there that I think is really important. And ideally, we want to abide by what Nelson has indicated is the best process, which is stick with the mutual company. There are many times where that's not the case. In fact, recently, I have a lady right now who's doing a conversion of existing term insurance, and she's doing it with a different company because she was actually not denied, but postponed due to some recent medical testing on an application with the mutual company. And because that could take 18 months and the time is going to go by anyway, we can get a really similar features, very similar structure of a policy for her by converting existing term insurance with another company. I have another gentleman I met with 2 days ago, similar process. He got a policy. He was in better health condition. Now, not in as good of health condition. He's added a little bit of extra size since the last time he did an application. And so he would be certainly experiencing a rating on a policy. And so we're actually better off right now, especially because he's also a smoker, in converting the other policy with the other company, even though it's a company I would prefer maybe not to do business with. Because Vern, can I just be honest with you? It's a company that pisses me off. Okay.
Yeah, I think I know which company you might be talking about.
I have a policy with them, and so do you.
Yes.
And it's a good policy. I'm not upset with my policy. I'm upset with the administration of how they administer the policy, because they're morons and they don't know what they're doing over there. And it causes no end of frustration for a client and for an advisor helping a client. And it's irritating and frustrating. And that makes you not want to do business with a company. They're also a stock company, but the policy itself, I'm okay with it. It's working well for me.
Yeah. Well, here's the deal, Rich, that I'll say about that. First things first, at the end of the day, the total cash value has to rise to match the total death benefit. Stock, mutual, I don't care. The cash value rises every single day and it can't go backwards. Number two, I have access to, let's just say a general rule, 90% of the total cash value. Anytime I ask for it, they're contractually bound to loan it to me. So all of those factors still exist. Nelson taught us to do the business with using the best tool that was available to you. So just like Richard's point, hey, I couldn't get the policy at the mutual company. Is that a reason not to get started? I'm super pleased with the 7 policies that I own at mutual insurance or at stock companies. I use them all the time. They grow every day and life is good. So that's totally fine. But you did an excellent job of describing that. I love that circle within the circle. I'm going to use that when I draw that for people, because I, sometimes help people understand how that works. But you did a great job of explaining all of that. And again, at the end of the day, it just comes down to the process and using whatever tool is available to you, as long as it's designed correctly. That's why you got to work with a good coach. But a quick note about term insurance. I drew a line in the sand. I made a decision. I'm never going to cancel term insurance. Well, particularly if it's with a company, whether it's stock or mutual, that offers participating whole life, ideally correctly structured for banking. But I kind of pulled a little fast one. It's totally on side. It's all good. So Rich, there is obviously medical underwriting to get one of these policies, but there can be some financial underwriting, especially if you're applying for kind of a larger a premium policy or a larger death benefit. The insurance company wants to know that you have a need for the insurance and ability to pay the premium. So that's part of our job as the coach, as the advisor, is to really sell the case to the insurance company and convince them that it's a good idea and a good fit for the client, right? And so we have to, gather data and have a plan in place and all that. So I did all those same things for myself. So I was able to, and I had to go on a big health journey and all that. A lot of people know that, 24 months ago or so, I was not insurable. So I had to go on my own health journey and get that cleaned up. So I was able to get the mutual insurance company to approve a pretty sizable policy for me in November of 2021. So pretty new policy. And I disclosed to them that I had a term life insurance policy that I had for many years, about 500,000 at another company, at a stock company. And so as soon as I got the policy approved at the mutual company, I immediately converted my term policy with the other company. So I added another policy to our system. And so it's a contractually guaranteed that they have to give me that whole life insurance with no medical or financial underwriting. So I was immediately able to get that policy approved as well. So that was really good. And again, that I'm quite pleased with both. So
And I think with that stock company, they made some recent adjustments where there was even less medical type questions, because you have the ability to convert into a standard base policy at any time. They can't restrict that, even if let's say you've got terminal cancer, you can do it. However, there's the flexible paid up addition top up portion that we're trying to do, where you want to maybe get that extra turbo boost into the policy. Because that purchases extra death benefit, it adds to the risk profile on the insurance pool. So they reserve the right to underwrite for that excess. Yes. But there's certain carriers have a little bit of wiggle room depending on what you're doing. And so I believe in that conversion you had, Vern, there was a recent change where you're able to implement a pretty decent chunk of that in there without any questions at all. Is that right?
Absolutely. So to your point, yeah, and I know this might get a little confusing for people because we're talking a little bit about insurance, but basically, you have a base or a required premium in the policy. It all generates death benefit and it all generates cash value and it's all eligible to receive dividends, just in different ways. So I have this base premium that kind of drives the long term and the efficiency, the daily cash growth in the policy. That's 100% guaranteed. When you have a term policy, you can convert some or all of that term, and that base is guaranteed. With most companies, that's what they guarantee. This particular company that we're referring to Richard's point, there's that additional premium that we want to be able to put in because it buys big paid up chunks of death benefit and creates a lot of immediate accessible cash, and it helps increase the daily growth and all that stuff. So we want to have that additional option to put that premium in. Most companies won't just give you that additional premium. You have to be underwritten sometimes financially and medically for it. But this particular company recently made a change where they actually will allow you to convert up to, I believe it's about $2 million of term insurance to whole life, where they'll actually grant you all of that additional deposit room, non-medical, non-financial. So I was super thrilled about that. So my base premium on that policy, Rich, is about $9,000 a year. And now I have the ability to deposit nearly $26,000 per year in the policy. So there's quite a lot of flexibility. So I was I was pleased as punch, as they say. But now that same company, I have to mention this. I love this company actually. So I'm very disappointed about this. For a stock company, they're pretty great. But they made a recent change as well that doesn't make them very ideal, though, for most people for banking. Because I have intimate knowledge, I understand the process, I understand the tools, I understand how it works. I'm fine with having the policy. But the problem with this company, Rich, and you know what I'm about to say, when I access a policy loan from this company and deploy it and use it somewhere, they've now made it mandatory that you must pay that entire policy loan back before your next policy premium date, or at least before you're able to put that additional premium in. So I borrow $5,000, $10,000, $20,000. I have to pay that all back and have a zero loan balance on my own policy. Otherwise, they'll only let me put the 9,000 in, which really doesn't work very well for most people, especially starting the banking process, because you're probably going to have loans paid off, loans paid off, loans paid off, or loan, pay a little bit, take another loan, pay a little bit, take another loan, right? So you're kind of always going to have a loan in your banking system because loans are good for banks because it attracts streams of payments. So if you have a loan balance outstanding, you must get it paid back before you can put that additional premium in. And that can pose a lot of challenges for people who are new and don't really understand the whole process. You see what I'm saying, right?
Yeah, and just to quantify that, so thank you for sharing that, Vern, because this is a new thing, and it's for it's only, I mean, I don't even know if we're a full year around the clock for when this change happened. So for anyone that has an existing policy with that company that's prior to this adjustment, they don't have that issue. And many of my clients have that as well, no issues there. But it's for new ones going forward. So it's kind of like with the insurance realm. One of our colleagues says that there's no deals in the insurance industry. Everything comes at a cost and a cost exchange. There's a benefit exchange, cost benefit exchange. And so you're paying a premium to get a death benefit. It's an actuarial premium. It's mathematically calculated. And then the advantage that they said is, okay, hey, Vern, you can put a little bit more into this contract than you could a year ago. The same contract, you can put more into it. But because we're allowing you to do that and we're not going to underwrite all that stuff anymore, we have to manage the risk on the pool. There's something that's referred to as anti-selection risk. And so if they don't underwrite people for that extra top up that Vern's talking about, there could be people who are completely medically uninsurable and they're just willy-nilly throwing money in and buying new death benefit. And so if they're also taking policy loans, like they have to strike a balance so that they can put an adjustment in place to manage the overall risk for the pool. So that's how they decided to manage that risk. And it doesn't make it ideal for IBC. However, it also doesn't make it impossible. It simply means the thinking that you have to do must get changed. And there's many ways of still accomplishing the same objective. It's just a matter of having a good conversation with your coach about how to do that. And again, something that's worth doing is worth doing well and worth doing it right. And that company might be the right thing for an individual because perhaps they weren't able to get insured at the other company. If they wanted to go do a policy with company A, but they weren't able to do that for whatever reason, and they already have existing insurance that we can convert at company B. Company B has some kind of silly knick-knack rules that we have to bounce around in and play in their, we're going to play in their sandbox.
Yeah.
We just figure out how do we play in that sandbox effectively so you can still accomplish the things you want to do.
Yeah, really good. Really well said, Rich.
Well, we covered a lot of ground here today, dude.
It was great. It was
not
awesome.
Not bad for going live in like 5 seconds from jumping on that call. But for everyone that's tuned in and for the folks who are watching on YouTube, make sure you continue your journey of learning. There should be another set of videos that's going to pop up here shortly. And I bet you one of those is going to be pretty fantastic. It might have my face, it might have Vern's face or somebody else. Go ahead and click it and watch that next video because you're going to learn a ton. Thanks for being with us today, and make your day amazing and make your financial life fantastic.
It was awesome.